and if hopefully you get a chance to have you know, the video working. I wanted to just sort of kick the session off today with some personal thoughts, just to try to keep it real for everybody. I think we can all relate. You know, this subject that we're dealing with, working capital, is one of the subjects that really gave me the greatest angst in the process of my, you know, as being an entrepreneur, and partly because I felt like I had, you know, I mean, bones, skeletons in my closet, you know, things that would come out about me. And a lot of times I know I felt, just as a Black entrepreneur, that it was, you know, more difficult for me to raise capital or to get the same breaks. And I never knew, there was no evidence of the difference. It just seemed that way. And so, you know, I really had to deal with my demons about, you know, whether it was, and we all have them. I mean, whether it's bad credit or a default on something, or, you know, late payments, or, you know, how many times I've been arrested for protesting or anything. You're kind of always wondering whether you're going to be good enough for the bank or the lender or the investor, the state. When especially at this stage as a CEO, you're really completely out there, almost naked, with all your imperfections, sitting in front of some folks that will you know, absolutely take a hard look at those imperfections. And I needed to address those demons personally. I needed to find a way to chart a course, despite my hesitations of trying to raise capital. Okay, I got to do this. I got to put myself out there. How do I do that? What chart can I go pick up to determine how to be good enough for them to give me money to pursue my dreams and my company? Was the technology good enough? Was my partners good enough? Did someone have something that was going to hold us back? And so it was always there. And so, you know, I think this week represents that next step in what we've been talking about. We started out with, you know, accounting 101, and then we went a little deeper than that. We talked about, you know, product market fit. We went a little deeper than that. And, you know, you get really pumped up about how great it is what you have and how you're going to do so well in the market. And then you have an opportunity to actually apply for the money, and not just apply for the money, but understand what money is meant for what uses. And that was a big question there, because there's a lot of different sources of funds that are available to you. Today, I emailed you a list of 75 venture funds in this particular area that, you know, and what does that mean? I mean, how do you actually deal with all of this now? And the one thing I know I can say for sure is that as the CEO, that's your job, right? That you cannot avoid this discussion, this conversation, and you cannot rely upon your CFO to do all the talking for you. That you're going to have to learn, you know, that the courage necessary to be vulnerable and to put your stuff out there. And so today we have the pleasure, the privilege of talking to a couple of gentlemen who can sort of help us think through sources and uses of funds and how that works. You both had, I should say, you all have had the opportunity to see Alan Smallwood's background with Cerebro, and Mark Harrison's background with Meridian Management Group. And so I wanted to just offer to you that this is an opportunity to ask those questions today, um, an opportunity to try to understand these kinds of nuances, and also understand how important it is to set things up right now before you get too far down the road and have to clean things up later. So I'm happy to bring in Alan Smallwood and Mark Harrison for this session today, that we're going to really have a chance to go in deep. We actually, depending upon Mark and Alan's available time, we can probably go a little past the hour, since it took a little bit of time to get started. But I wanted to open it up with a somber note like that, a personal note like that. And there you are, Mark. And to open up the conversation that way. So to kick things off, let me just ask Mark to start, and then Alan, you can pick up after Mark. Could you tell us a little bit about your company, a little bit about what how you got there, and we'll just kind of like get an overview of that, and that'll help us to tie in some of the questions that we're going to have throughout the afternoon, or should I say the rest of the morning today. So Mark, it's yours.
Great. Good morning, everyone. Mark Harrison with Meridian Management Group. Meridian Management Group is a privately managed investment management firm, but we have a contract with the state of Maryland to manage basically the primary small business financing program for the state of Maryland. It's called the Maryland Small Business Development Financing Authority. And that Ms. BIDFA for short. If you're going to be dealing with government, you need to get used to acronyms. So Ms. BIDFA basically finances, our focus is small businesses, minority-owned businesses, and women-owned businesses. And we provide a range of financing services, from contract financing to loan guarantees like you would get at the SBA. We provide surety bonding, and we also do equity investing out of that fund. I won't go into continue to go into details about myself, how I got to MMG. Ironically, years ago, I'm a lawyer by training, and wound up at what is now the Department of Commerce, representing not only the Ms. BIDFA program, but they also had, they were starting an equity investing program at the state of Maryland, which is now housed at TEDCO. So kind of the precursor to the Maryland Venture Fund and their seed fund. I was general counsel to those programs and actually transitioned over to the other side and became the deputy director of those investment programs. So, and I've gone on to do other things within financing of small to mid-sized businesses, including tech businesses, including a stint at the SBA, specifically looking at issues, how to finance and how to develop and grow small tech companies. So excited to be involved in the conversation today and hopefully be able to add some value.
Thanks, Mark. Alan, could you share your similar story for us, please?
Yes, no problem. Am I coming through clear?
Yeah, you are.
All right, great. Switch my microphone up midway through.
No. Okay.
I'm Alan Smallwood. I'm the head of the capital markets team at Cerebro Capital, which is also a early stage Baltimore-based technology company. We are building a fintech platform that helps borrowers and lenders connect in the small and middle markets, primarily around debt capital needs. We've been around for about 4 years. We've been commercial for the last 2. And the best way to think about us is we're very similar to TaxCut. TaxCut is a software that takes a arcane process like filing your taxes, which has all these different rules and different decision nodes, and helps you navigate that process. Searching for debt is very similar. There are a lot of different types of providers. They all have different requirements and different prisms to which they assess somebody's financeability and the amount of capital that they can provide them. And that's what our software does. It looks to your subjective, qualitative features of your company, and then also matches them against the financial features of your company, i.e. the financial historical results, projected financial results, and maps that over to known underwriting criteria for various lenders across the market for different discrete types. So using that software, my team, we go out on behalf of our clients and help them place debt capital in a competitive, comprehensive search process.
So you used several terms that it took me a while to really understand, but let me just kind of try to do a couple of things just to sort of set the tone here. You mentioned small and middle markets. And, you know, there's also the discussion about what's an early stage and a mid and late stage company. From your perspective, tell me what you mean. First off, what is small and middle market? And then I'd like both of you, if you could share what, if let's see if we have the same definition around what a early, mid, and later stage company is.
Mm-hmm. Certainly. Would you like me or Mark to go first on that?
Yeah, go ahead, Alan.
Yeah. So unfortunately, there isn't a clear definition of what any of those terms mean. Every lender will bucket those categories a little bit differently. That being said, there are some generalities I think that you can assign what type of capital you're looking for. But basically, a small versus a medium-sized business, from our perspective, it's rule of thumb would be somewhere around the $20 million revenue mark, and somewhere around the $5 million EBITDA mark would be the level at which you switch from being a smaller business to a true middle market business. Now, I would say, depending on the business, those numbers can vary quite differently, right? Because that implies if you go 20 and 5, that's a 20% EBITDA margin. You know, what percentage of every dollar of revenue you convert into operating income? 20%. Some businesses, particularly tech businesses like the ones we're here discussing, once they scale, their EBITDA margins can be materially higher than 20%. They can be in the 30, 40, 50% range, just depending on the business. So that's a general place in which.
So Alan, what do you mean by EBITDA?
Yeah, EBITDA is operating income. So what's operating income? Operating income is your revenue less your cost of goods sold. So if you're making widgets, how much does it cost you to acquire the materials and manufacture those materials into widgets? That's the first reduction to your revenue line item. That nets you what's called a gross profit margin. And then your gross profit margin, you then have to allocate your overhead, corporate overhead expenses. Those are things like your marketing team, your HR person, your accountant, your CFO, et cetera, et cetera. Your rent for your building, your office supplies, if you want to put little treats out in the break room, that kind of stuff. So once you reduce gross profit margin by all those additional expenses, you're left with what's called EBITDA, earnings before interest, taxes, depreciation, and amortization, EBITDA. So that's cash flow potential of a business before you pay for your debt, before you pay Uncle Sam, before you depreciate any equipment or capitalized assets that you might have on your balance sheet.
Mark, how do you and how does the state look at those definitions?
Right. So generally, for our program, we'll go by SBA guidelines. And so it'll vary depending on kind of what industry you're in. So, for example, I think manufacturing has a larger number, and you can still be a small business. I'm not exactly sure what the amount, what the revenue amounts are. But the point is that different businesses, depending on your industry sector, will judge small business differently. But I generally kind of port to similar to Alan. If you're under $20 million in revenue, you're a small business. And he's absolutely correct. Depending on who you're speaking to, those amounts will shift. So from 20 million to maybe 75 or even 100 million, you might say that's a lower middle market company. So even the middle market has different tiers to it, right?
Yeah.
So, but you know, it's good for you to understand, but
that's what I'm about to say.
You know, it's not, you know, I don't know if it's something you need to spend a whole lot of time and angst about to know, you know,
right. That's right.
Whether I'm a lower middle market company or am I a middle market company. At this point, I believe most of you are, you know, very early stage companies. You know, you're probably pre-seed. So while it's important to kind of think about the future, you know, this, you know, kind of where you are, you know, whether you're middle market, lower middle market, is not particularly impactful at this time.
Yeah, exactly. So you know, and I remember hearing these and thinking, well, I'll worry about that later, kind of thing, right? That you wind up hearing these things about $20 million in revenue, and we're pre-revenue companies. Some of us are pre-revenue companies. I think, you know, how that relates to seed financing, where we are. So let's kind of talk about the landscape a little bit for the companies, or for the place that our companies in this cohort are, and many of the CEOs that are also, you know, listening into this conversation, because we're at that seed level. And maybe some of them have more or less, but can you kind of give us the landscape on defining where we are? Mark.
Yeah, so I guess, you know, kind of terms of kind of options for financing, particularly from another investor point of view, an outside investor point of view. So I think the first thing, you know, we probably look at is to say, okay, how much money do you have in this business, right? How much capital have you actually put into your business? And I know everyone says, oh yeah, I put a lot of sweat equity into my business. To be truthful, you know, that doesn't carry a lot of weight. You know, the investors are going to want to know how much capital that you put in. Next, you kind of have your friends and family, people that you know, who are willing to take a chance on you and, you know, provide you some capital to get you going based on your kind of personal network to move forward. That's probably the stage at probably where most of you are at this point, I would imagine, particularly if you're pre-revenue. Then, you know, you get to this seed round, right? So the seed round is probably for companies like yours. You may get some angel investors in there, and angel investors are just people who generally have been very successful and have money to invest in early stage companies like yours, with the hope of a larger payout moving forward. So they're professionals, they're cashed out entrepreneurs.
Is there a general size that angels tend to invest in, just for generalities?
No, it kind of ranges, you know, from generally as low as probably maybe 25,000 up to, you know, 50 individually now, you know, 50, you know, it really depends on, you know, who your angel is, and it can go lower. So there's no general size, but you also have angel groups where you have potentially a number of fairly wealthy individuals come together, and they invest as a group into different businesses. They evaluate companies, and they decide whether they, as a group, want to invest into a particular company. That's kind of
so one of them, you're talking about, like the Baltimore Angels is one of the groups of investors that come in as a group and look at different companies that way.
Yes.
Correct. Okay.
So, you know, the only thing I want to warn, you know, is that, you know, you can spend a lot of time chasing money. Okay. You know, the angel groups and angel investors and, people who provide kind of equity or equity-like capital to your businesses, it's hard to find. You can, venture capital funds, you can get a list and, they're all over the place.
Right.
But folks who are able to provide funding at this stage of your business, you really need to kind of rely on your network of people to try to connect you and get you in. Because the best way to get an investment is someone has to refer you. If you send cold business plans, chances are, you might not, unless you really hit a direct sweet spot for that investor, you might not get a lot of response. So the best thing is to get networked in, either through your guys like John, through the program you're working with. They have relationships. Your lawyer, your accountant, if you're working with one, your personal network. That's kind of the way you want to try to find investors.
Mm-hmm. So, Alan, from the standpoint of the kinds of capital that are possible, especially when you have a project that's out there, someone is saying, "Hey, I'd love you to do this event for us. We actually need to get capital to do that." Short-term financing. What seems to happen a lot with the companies at our stage is that, we're at that point where opportunities are there, but money isn't there to help build out that opportunity. How does one look at that in terms of the landscape? We're still kind of talking about, all right, I need to finance this, but I'm not paying my people. I need to, so there's different needs, but there's different limits on how you can use certain monies. Can we sort of begin to discuss that a little bit as well?
Sure. So that's really focused in on what's the use of funds question, right? Every transaction that we present to a potential lender, we're always very clear about what are the uses of this money, the nature of the uses of this money, and then the timing, most importantly, the uses of this money. Lenders are more conservative than equity investors, right? They're looking for a smaller total return. So if they have a deal go bad, that can be very detrimental to their entire portfolio of loans that they're making, right? Because there's just not a lot of return to offset mistakes.
Yes.
So that gets into the what's the nature of the money that's being spent, what's the likelihood that it's going to generate cash flow for the company, and that cash flow is going to be the source of the repayment of my loan or the interest rate on my loan. So that's really important. There are different ways to categorize the use of proceeds. The two most specific for businesses such as this are what are my working capital financing sources. So think of that as at my current operation, my expense to operate the business day in and day out. Mm-hmm. And then there's a different source of funds, use of funds, which are what we call growth capital expenses, right? Those are expenses that are designed to expand the business. So for example, I've got a business, I sell only in the Baltimore, Maryland area, and I want to go down the road to Washington, DC, right? I need to hire a sales rep down in Washington, DC to expand my business. Well, that sales rep's not going to be producing revenue immediately. Maybe they will, that depends on the nature of the business, but most likely they're not. So that would be considered a growth expense, right? Even though that person is on your payroll and that's part of your day-to-day operations of your business, they are doing something that is more speculative in nature. So they're evaluated through the money used to finance that person is evaluated through a much different prism than, we've already got existing business and we're just hiring another person to service it. So that's one important element in kind of determining what it is that we're trying to finance. Mm-hmm. The other element is timing, right? So, for example, if we were to go out and get a loan for that new business rep down the street in Washington, DC, we need to have a realistic understanding of how long it takes that person to be able to produce revenue and at what amount. right? So yes, we're going to have a month to be able to, canvas the market. We're going to have another month focused in on selling to the people we identified through that canvas. And then in that third month, we're going to be signing contracts and start generating dollars of revenue at the end of month 3, right? So that's the kind of the analysis that the lender is going to be interested in understanding. So in terms of the providers of different capital for that, there are a few different types. Things that are more operationally focused. So I've got a business, I'm generating revenue. I need to be able to better finance my working capital to optimize my cash production so I can continue to invest in my business. That is best suited for a more traditional lender like a bank or via the SBA program or smaller business focused government-backed program or other initiatives like local, municipal, regional, state. Things that are growth oriented in nature, you're asking somebody to take a bigger risk, right? So, while many products or services can easily be exported from one city to the next, right? There's going to be the same types of buyers for your product, your service in Baltimore as there are in Washington, D.C., let's assume. While that exists, it is still much more speculative in nature because you're entering into a different market where there's probably already an incumbent service provider, et cetera, et cetera.
Right.
So those carry much more risk and they're much more speculative. So those types of lenders tend to be what we would call a non-bank lender, not a non-commercial bank commercial bank lender. So those are your private debt funds, your venture debt funds, et cetera. So, and they tend to have a higher requirement for payback on their money because they are the ones taking more risk, right? We're not trying to raise funds to service known business production and potential. We're trying to raise funds to service new and speculative business production potential.
So there's like risk is obviously the big word here, Mark. How is risk measured from the standpoint of the state and then from the standpoint of the private sector? I know that different kinds of funds available for different things. People talk about SBIR grants. I understand with SBIR, only 7% of the grant can actually be used for non-research items. Certain money that comes from the state has also specific uses associated with it. And risk seems to be a word that applies to all of these different things. Is there a way that we can look at how we would internally measure our risk? What are the CEOs that we have up against when it comes to risk?
Right. So I guess the thing that you need to understand with regards to risk is that as the perceived threat of either non-repayment or non-return or return that the investor is looking for increases, you're perceived to be more risky, and therefore you're going to pay more money. The money that you're going to get is going to cost you more, right? So if I'm lending to a company that's in business and it's showing it's the kind of financial performance, I can lend to them at a certain rate. But the types of organizations that Alan was mentioning, like you said, they're taking more risk, right? So they may still lend to you, but you're going to pay more for that money than the more established company will, So there really is something to the, you might hear people say, oh, you can only get a loan from a bank if you don't really need it, right? There's actually some truth to that, because what the lender is looking for, and if the company doesn't need it because they're firing on all cylinders financially, then yeah, the bank is saying, yeah, that's a good risk for us to take. So it's good to understand kind of how you're perceived in the market at this point in your business development. You don't have an established market, you probably don't have an established customer base. And so the money that you're looking for, particularly from lending sources, is probably going to be higher. That's why kind of the friends and family and your ability to bootstrap is very important kind of during this stage. One thing I also just kind of want to mention at this point is that I think it's very important for you as kind of the CEOs of your company, regardless of who you're getting money from, right? Whether it's debt, equity, you need to understand how the person you're receiving the financing from gets paid, okay? Because what'll often happen is, you know, you're telling the wrong story to get the money to someone who's not particularly interested in that story. So what I mean by that, right? So if you go to a lender, right, the key thing the lender wants to know is, how am I going to get paid back plus my interest? So you need to be able to demonstrate to that lender that, hey, this is how I'm going to generate sufficient cash flow in order to pay you back. If you take that same conversation to an investor, right? An investor doesn't get paid back that way. He's interested in how your business is going to grow to the next level, because he's going to invest at your company at one point, and he wants it to grow in value, and eventually he's going to exit that investment. So that's how he makes his money. So while the conversation about your ability to cash flow and meet your obligations kind of on a monthly or annual basis may be important, but if you push that on him, you're not talking. He's not hearing
right.
what he needs to hear in order to make the investment. So, and if you flip it, if you go to a bank and you say, "Oh, you know, I'm going to get this money and I'm going to grow like gangbusters. You know, I'm here and I'm going to be worth 5x in 3 years." You know, the lender's there saying, "Yeah, but how are you going to meet my debt service next month?" Right? So
Right.
you're talking past each other. So it's critical for you guys to understand who you're talking to, how he gets paid back.
Yes.
And that way you can have an intelligent conversation and you're talking the same language, and that's how you can get them engaged in financing it.
Alan, I saw you shaking your head with a couple of comments there. Want to add anything there?
Yeah, I think the understanding the how and the when of when people are going to get paid back is very important, right? Because that to Mark's point is exactly the story that they need to hear, right? And the story you need to be able to tell to them. Most importantly, a bank is usually expecting to, or any type of lender is usually expecting to start receiving what we call debt service, i.e. the interest and potentially the amortization or return of principal almost immediately in many instances. Sometimes they'll give you a interest only period where you're only paying the interest rate and you don't have to pay down any of the principal. But typically they're looking to get paid back almost immediately, right? So the importance that you need to ascribe to that is, I need to be able to show that what I'm going to spend my money on can make me generate more cash than I'm spending, right? And I need to be able to do it sooner rather than later. Versus an equity investor is looking for, I need to eventually give my money back to the people who gave money to me, but I don't have to do that necessarily tomorrow. And I don't necessarily have to do that next month. I have to do that in 3 years, 4 years, 5 years. And there's a different way in which I'm going to generate that. I'm going to either sell my interest in your company along to somebody else. You're going to sell the whole business. We're going to take on new debt or new capital in the form of debt that's going to be distributed as a dividend to all the equity owners. There's a lot of different ways for them to get paid back. What's most important about all those different ways is they're way off into the future, usually, right? So that's a different type of story that you need to be telling to them. It's not I can sell this many units over the next 6 months to this person at this rate, and it costs me, something else to produce them. It's, I'm going to gain this much of my addressable market. and somebody else is going to value that piece of the addressable market at 5 times my cash flow or 2 times my sales or some other metric. That's a much different story. And one of the biggest things that I see when we're taking people out in the market is they just don't know their audience, right? And they are the owners of the business, right? And they're all excited about the big future and how what they're doing is going to change the world. And that's great. And that's what makes entrepreneurs special, but that's not what a lender is interested in, right? So knowing how to talk to somebody that's on the other side of the table and what's important to them is really, really important. And you got to do your research or work with somebody who knows what's important to that person. And that's why we have a business. But
excellent. Angel, I see you had one, and then also Patrick. Why don't you unmute yourself and want to go ahead and address those questions that we've got so far? And anyone else that would like to go after Angel and Patrick?
Patrick, you were first, so you want to go ahead?
Oh, yeah.
Okay. Hey, good morning, everyone. So
You're muted, Patrick.
I'm still muted. It doesn't be muted on.
I can hear it. I think you're okay.
Go ahead, Patrick.
Okay, cool. Understood. When you said that they kind of want validation.
Are you folks hearing him?
Okay.
Cool. I don't know.
just stop
I'm not. Okay, got you.
You talked about like the validation. They kind of want to see what you've put in, not sweat equity, but like actual money. When it comes down to that, are they looking for receipts, invoices? Entrepreneur life is tricky, so there might not be consistent purchases, and we do put a lot of sweat equity in. So how do you go about validating those things to them?
Well, if you put some money to kind of finance your operations, right, that should be reflected in your financial statement someplace, right? So if you put 5,000, you put 2,000, 1,000, whatever the number is, right? That should be reflected in your financial information. So you should be tracking how much money that you are coming out of pocket to support your business and that's how you validate your investment into your business. And while I'm speaking on that, this is kind of allow me 2 minutes to get on my soapbox here.
Yeah.
Financial information. So the biggest unknown, if you will, for lenders or equity investors, right, is how good is the financial information you're giving me? You might be giving me, some spreadsheets or some accounting program, financial information. The lender or the investor has to evaluate kind of how reliable is this information that you're presenting to me. And so I am a big proponent of using accountants and trying to get the highest level of accounting financial statement prep that you can afford and make sense. So there are basically 3 levels, right? You can go to an accountant and they can compile your financial statements, right? And basically they just take your financial information and they put it in the right categories, right? Mm-hmm. Next is a financial statement review, which they do a little bit more kind of digging and checking into your financial transactions and kind of put that into the proper format and issue a report to that effect. And next is an audit, which is a total deep dive into your business, and they provide a letter to that effect. No one here needs an audit, okay? And probably none of you need to have reviewed financial statements. But I can tell you as a lender, even if you just had your financial statements compiled, right? For me to know that an independent set of eyes, financially savvy, has looked at your books and records and has provided, your financial statements to me, just moves the process further, in my view. That third party validation, and granted, again, they just put it in the proper order, right? They're not doing a whole lot when they compile your statements, but even that will separate you from a lot of other early stage companies. And again, if you can afford it, I'm just suggesting that is will separate you from other businesses similarly situated. If you can't afford it, if it doesn't make sense, then don't do it. But I'm just telling you from the other side of the table, if you present that kind of information to me, that I can check some boxes mentally and say, okay, this company, this might be a real opportunity for me to either lend or invest in.
Yeah.
So your final question is, how is it validated? Is your financial statements should reflect the cash, your cash infusions into the business.
Yeah, I'll just piggyback on this comment because it is one of the most important things in being able to raise money, whether it's debt or it's equity, is being able to tell the story, right, of what's happening with the financials. The way I always like to describe it to people is finance is a language, right? And there's a lot of different subdialects of that language, whether you're talking about an equity provider or a debt provider. But at the end of the day, it's a language. Right. And you as an entrepreneur or a business operator who's in a completely different purview, unless you're doing fintech, you don't speak their language. Right. And your financial statements are the Rosetta Stone. They are what's going to take what you've done in terms of how I've spent my money, what I've spent it on, and where it came from, my customers, myself, some other investor, and translate it over to them so they can understand it. After knowing what to ask for and how to ask for it, the second thing, most important thing, is knowing how to tell your story financially. And I've seen deals where there were all the good things you could possibly want. Plenty of cash flow, plenty of hard assets like real estate with good values, et cetera, get derailed because the CEO was obstinate of, I'm going to do my own financial statements in QuickBooks and this Excel spreadsheet with all these Band-Aids. And I've got a big business and I just can't, like, you look at it and you just can't understand what's going on. And all the stuff that he needs to get the deal done is there. He just can't tell his story via his numbers. It happens.
Yeah. I was just going to ask you about that. If you would both kind of take a whack at this, Alan, how, even with the right set of eyes or another financial statement on there, how important is it for the CEO to speak that language and get into it and understand that language?
It's extremely important, not just for being able to ask for capital, but it's really important for you to understand how to operate your business, right? Because today's discussion is around working capital, right? It's how am I going to pay the bills month to month to month? You need to understand this is what it costs to produce my product or offer my service, and this is what I can charge for it. But most importantly, this is how I'm going to get paid for it, right? Because there are all these other concepts like the days your sales are outstanding, right? If you're offering people the ability to pay on terms. So I produce a service today, I book the revenue today, it shows up on my P&L statement, but I don't get any cash for 90 days. Right. And selling to the government, it might not be 180 days, if at all. Like, what happens if there's a government shutdown? Not being able to understand how you convert $1 of sales booked to $1 of cash received will kill your business. Right. It will also make it next to impossible to be able to raise capital, because that's the first thing people ask. It's like, all right, well, tell me about the working capital cycle. What they're trying to understand is, how does what we do from an accounting perspective in terms of recognizing revenue convert to receiving $1 of cash flow from that same customer? What are the risks of collecting that $1 of cash flow? How concentrated are my customers? Like, how many do I have? I reliant on one contract with one provider and they've got the ability to walk away and I'm left holding the bag. All those different things matter. And all of that is easily understood by looking into the numbers and the commentary we provide around those numbers. So it's extremely important, not just to be able to ask for capital, but to make sure that you are operating your business in a manner that allows you to wake up every day and know that you can turn the lights on.
Mark.
Yeah, and I echo that. I think that was a great summary. But I understand that that you are, you're entrepreneurs. You got into the space to do what you're doing, not be a finance wizard, right? And I don't think you need to be an MBA in finance to be a CEO. But at this point, right, you are wearing multiple hats
Right.
at this stage of development of your business, right? So you've got to be able to articulate your financial story going forward. The CEO of Microsoft doesn't have to be able to do a deep dive and all the numbers because he can afford to hire staff and a CFO to do that for him. But he can't be totally ignorant to it. Even he has to understand a lot of the things that Alan mentioned, kind of how we make money, how we get paid, what are the risks there. So it is incumbent on you to take that on, even if it's out of your comfort space. Because for you to be able to develop and grow your business, you're going to have to answer those kind of questions. Even when you start to get to a size where you can afford to bring in someone to help with the finances. I've seen countless stories of CEOs relying on chief financial officers and not being able to monitor what they're doing, what the CFO is doing, and due to theft, incompetence, whatever, that the business blows up. So this is your business. You are the leader of this business, and knowing the finances and the numbers.
Mm-hmm. So let me just take it a step further with you, Mark, and both of you actually. It's not just a financial statement, right? I mean, it's the corporate affairs generally as well, isn't it? I mean, what else do you look at? I mean, when the bank or the equity investor is taking an evaluation of risk, are we also looking at, is the company in good standing, what the corporate papers are like, what the minutes of the board meetings? Could you go a little bit into that aspect of it, Mark, first, and then Alan, and then I want to go to the question that Angel has.
Right. So in terms of those kind of things, so I think for lenders, well, it's all generally important, right? But good standing, I can tell you at the state, good standing. If you're not in good standing, we can't give you the loan, right? You have to get your business in good standing. We look for tax liens. If you've got outstanding tax issues, what we want to know is whether you have some kind of payment agreement with either the federal or state government. Then we can proceed, but it's important that if you've got outstanding tax obligations, that has to be taken care of. In theory, the lender is going to want to see that, pursuant to your corporate minutes, that all corporate actions have been taken to authorize the company to enter into this loan agreement, right? So, and even though that you're really getting into the nitty gritty of kind of due diligence, but that is part of it. That is probably even more critical. The kind of minutes and things like that. Your articles of incorporation are even more critical on the equity side, because the rights and preferences of the equity are defined in those agreements, right? So if you've got preferred stock or common stock, the rights and preferences are defined there. So the investor is going to know that you've taken proper steps to authorize those shares, that you authorize the issuance of those shares. I mean, on the equity side, that stuff is extremely important. And again, not that it's not important on the debt side, but on the equity side, it is immensely important.
Thanks. Alan, you'd like to add anything to that?
Yeah, I want to touch on the concept of alignment, just to piggyback the comments. So yeah, there's all the blocking and tackling of making sure that, you know, from a good standing perspective, things are just as they need to be, et cetera. There's also this concept of alignment, and this is really important both for equity investors, but also for debt investors as well. Is they want to make sure that, you know, beyond the fact that you put some money into this thing and it would go poof if you weren't able to execute the business and had to shut your doors. They're also looking for proper alignment on behavior through time, right? In Mark's world and in other parts of the capital markets, a lender will perfect, we call it this alignment, or initiate this alignment via what's called a personal guarantee. Right? It's this concept of recourse. It's not just that I put money into this business and that money is at risk if the business continues to operate or ceases to continue to operate. It's also that I'm going to make the right decisions for all of my stakeholders in a balanced and appropriate way through time after I get the money. So, companies of this size, where you don't have a big fancy board of outside investors and an audit committee and a technology committee and all these different things, the best way to do that is to go to who's the person who makes or has full control to make all the decisions for the business day in and day out. That's the CEO, principal owner here in an entrepreneur-led business. I want to make sure that he is on the hook or she's on the hook, and therefore is making decisions that aren't Hail Marys and just trying to like max something out in the long run. It's making sure that day in and day out, I'm making the right decisions to keep the doors open, keep the lights on day to day to day to day. So the way to create that alignment is through this concept of recourse or a personal guarantee, which basically means you as the entrepreneur are saying, I want to take your money, Mr. Lender, but I also am willing to guarantee that it'll get paid back, right? And you can come after me personally if the business goes away. That's a requirement for a lot of different types of lenders. It's not a requirement for all. Mm-hmm. But when you cease to, or you're trying to extricate yourself from that alignment, you're going to pay for it, right? So a lender who will provide you capital and not hold you personally responsible for the repayment of that capital is going to charge you 2-3 times as much to get it as somebody who will. Excellent. Because there's no risk.
Excellent.
And let me just say, John, that for the Maryland State program, we require a personal guarantee of all owners over 20% of the company. All have to provide a personal guarantee. Me personally, I don't like to do it on kind of smaller loans, but I have colleagues who will require personal guarantees all the time. And not only a personal guarantee, but we will require that your personal guarantee be supported by collateral, and it's usually in the form of a lien on your house. Right? So you come to apply loan, you say, okay, you need your personal guarantee that you will repay this loan if this doesn't work out, if the business goes bust and this works out. You will repay this obligation, and oh, by the way, to even ensure more than your word that you're going to repay this obligation, we're going to take a lien on your house to secure your personal promise to repay the loan. And there are other potential assets that a lender can take, right? If you have stocks, they can take a lien on those types of things. Other personal property, they can take a lien on. But just from the state, I can tell you, house, if you own a home, we will take a lien on the house, even if you got no equity in the house. Right? Mm-hmm. There's no equity, right? Even if you got 2 or 3 mortgages on the house, you come to us to borrow money from the state, we're going to ask for your personal guarantee, and we'll take a 4th lien on that house. That is partially because it's a state entity, and we basically have to try to underwrite transactions to the maximum, right? To any chance of recovery, the state has to have the ability to recoup its investment because it's a state program. We have certain fiduciary responsibilities that we just can't waive necessarily. So, but you should understand that most understand at this point, your personal credit and your personal finances and the business are almost the same.
One and the same. Yeah.
Does,
yeah. Go ahead.
Sorry, this is not my question actually, but this came to mind because we talk a lot about, especially in the previous sessions, the whole idea of not piercing the corporate veil and like keeping your personal separate from the company. So how does that kind of, it seems to be incongruent with that idea.
Right, but again, at this point, so that's why it's a personal guarantee, right? So we understand we are making a loan to your business, right? And right, if the personal guarantee wasn't there, if that business doesn't work out and the loan can't be repaid, then the lender has no recourse, right? Because the business is defunct, right? So that's why we say we get a personal guarantee. We're asking you as the owner, primary entrepreneur of that business, we're like, hey, we're gonna lend to your business, but we want your personal assurance that if something goes wrong, you're going to make up. So yeah, you can do it. Not all lenders in the market will require that, but as Alan said, if they don't, chances are it's more risk, right? And as we said earlier on, the more perceived risk, the more expensive the money is going to be. So you're going to pay more not to provide your personal guarantee on that.
Yeah, and the
cynical,
sorry, go ahead.
I was just saying the cynical answer to your question, Angel, is that certain pathways in the market, in the financial markets, are one-way streets. So from a concept of like not mixing your personal expenses with your business expenses and being able to clearly through the financial statements delineate between the two, that's one of those one-way streets. Yes, you as a business operator, as principal of your business, have to make sure that you are doing all those things. But when it comes to the lender wants to get paid back. And unfortunately, there are certain pools of capital where they say, I'm going to look at this risk on a what they call a pool basis, which is the business and the business's ability to pay me back, and owners and their additional ability to pay me back. And I'm going to put it all together. And that's unfortunately, it's just one of those one-way streets in the market where at a certain size, it's something we have to deal with until we grow the business to a certain level where we can do it on a non-recourse basis.
And not all money requires that level of guarantee, Angel. That, but I tell you, the state is one of those parties that it's kind of like, on one hand, they're creating pools of money that are there for Black people, women, disabled, and others. They're trying to do sort of special programming because of race or gender or other issues. And that's really cool that they're making those special programs, but those are the programs that come along with those really, those personal guarantees and other kinds of collateral that are being used a lot of times. So I've found sometimes that, it's good that the state does that, and understand in doing so, the state's going to want those kinds of protections. The other thing I wanted to ask, and I know we're kind of running over, and I know you were thinking about this as well, Angel, was that, how do you define growth? What is the, Alan, how do you, what do you look at when Angel or one of the companies says, here's my growth strategy, and we're, kind of now focusing more on the equity side, Mark, as well. That we're focusing now on the equity side, and the investors that we're talking to are looking for a 3%, or should I say 3 year or so return on the money. How do we tell that story? I get how we tell the story about financially and where we are financially. How do we tell the growth story?
Yeah, the growth story is a few different things, but most importantly, it's understanding what are you trying to sell and who are you trying to sell it to and who else is already in the market, right? And how does your product or service differentiate itself either in features or in what we call unit economics, which is basically price, right? And your ability to be able to convey that to a potential capital provider is very important, right? Because you can't just say like, well, you know, GDP or something's growing, the government or the economy's growing by 3% every year.
Yeah.
And therefore I should be able to grow my product 3%. Maybe, maybe not, right? So the question is like, all right, who am I going to go after and sell this to? And why is what I'm going to offer them not available currently or differentiated from what is available? And do I have the ability to be able to communicate those benefits to the customer and will they adopt? So depending on what stage your company is, there's a bunch of different ways that you can do that. But I mean, a good growth story is really a good competition story, right? And it's why what I'm doing different than what's being provided or is underserved in the market or something, right? Mm-hmm. And how am I going to capitalize on that? And what is what's currently offered in the market and what are their kind of like, you know, features. So there's like this concept of the Porter 5 Forces, which is like a business school term. I would encourage you to go and look it up because it gives you the framework by
repeat that term.
It's called the Porter 5 Forces.
The Porter 5 Forces.
Yeah, and it's a strategy concept that's basically like, all right, you know, who are my customers? Who are my suppliers? What are the moats that I can build around my business? And being able to talk about what the landscape for your service and product looks like and how you are shifting the landscape or competing within that landscape is the most important story, because from that, I can make an assumption of there's not a lot of people providing this service. Everybody needs it. And therefore I can justify a very high growth rate if I can just get in front of people and tell my story, right? Or actually, there are a lot of providers for my service. So the market is competitive, but it doesn't cost a lot for a customer to switch from the current provider to my service. And I'm going to offer these 2 additional features, which are going to incentivize that switch. Those are 2 completely different stories,
yeah.
Right? So you need to know what it is you're doing in the market and what your customer is doing in the market and who those customers are, and be able to say credibly, I think I can do this because of these initial conditions. I should be able to execute. Or no, I can't do this, but I can do that over here. So a good growth story is really about understanding what it is you're offering, how it's different than what's currently being offered, and what your customers need and whether they can switch to you or not. So it's
great.
Yeah.
And so Mark, you know, I mean, from the standpoint of the state or these programs, is a good growth story, is that a way to reduce the cost of money? I mean, is it a negotiating point where you say, hey, I'm going to do this, so why don't you give me a break on that? Or are there, you know, I got a great growth story, so do I have to do the personal guarantee? I mean, where's the flexibility? Where's our power as CEOs to negotiate? It seems like, is this part of that power, that how well we understand competition is going to convey a better story so that the money is cheaper, or does it matter?
Right. So yeah, it does matter, and I'm going to answer the question this way. So as an investor, we're talking kind of an equity investor at this point, right? Basically, and it's important for the entrepreneurs to know this, I have a pool of money I've raised from investors, either institutions or wealthy individuals. They've given me some money and they said, Mark, you go out and then you invest in these private companies, and this is the return we're expected back on the money we've given you, Mark, right? So now, as I'm evaluating different investment opportunities, all of what Alan said is extremely important in developing your growth story. But in the back of my mind is, if I invest this money in this company, if that growth story comes true, does it meet my return requirements, right? If it does, then I'm interested in the business. And that's where your kind of negotiating power comes in, John, right? If I see something and I say, oh my God, this is gonna give me a 50x return, whatever some enormous amount of return, yeah, I'm willing to, kind of negotiate on terms with you. But it in the back of each equity investor's mind is, will this meet my return expectation at the time I need to exit this investment? And I can tell you that the major issue, entrepreneurs, will tell me sometimes, oh, venture capitalists, they just want to come in and want to take over your company and run the company. No, they don't. They do not. What they want you to do is grow your company at the rate they need you to grow it, right? And where the friction comes in is they invest in your company and you are growing at 3x, right? You're like, wow, I'm kicking butt, right? My company's growing at a 3x rate, but the investor needs you to grow at a 10x rate. And so while you think you're kicking butt, he's like, you're underperforming. And that's where the friction comes in, because you weren't quite sure what his return expectation was, right? You need to be clear on that, because it impacts how you run your business, right? You can run your business one way and get a 3x return. You're running a good business. But if you've taken someone else's money and they need a 10x return, well, now you got to think differently. What do I need to do? What changes do I need to make on how I run my business so that I can get a 10x return? So, keep that in mind whenever you take someone else's money, particularly equity money. But the concept of having some flexibility is, if the investor thinks that you can meet and or exceed their return expectation in the time they're looking for, then you have some ability to negotiate. So if something novel comes into the market and there's nothing out there like it, or there's something that's going to blow away what everyone else is doing in the market, you can tell that story, as Alan was discussing, and make it clear to me and demonstrate to me how that's going to play out. Then you have some ability to negotiate.
Yeah, thank you. Angel, did you want to follow up on that?
I did. I wanted to ask a question on the other side of that, because a while back, Alan, you had mentioned the exit strategy, and this is a conversation that I recently got into, and I'm just kind of learning. It seemed to me from what you were saying that there could be other options that investors can have in terms of recouping their investment, besides just you being acquired or going public. And so I'm just wondering if you could talk a little bit more about that, because it seemed like those were like some of the only options that I had heard about before.
I think one of the things to keep in the back of your mind is that when you're capitalizing your business, and by capitalizing, I mean taking capital from debt providers and equity providers to get a total cash in the door to support the business, there's no need to keep that static through time. So down the road, once you've successfully scaled and achieved a certain level of market penetration or some other metric, you will have options to access new types of capital under different terms and conditions. And how you then use that new capital can vary. So there's a common transaction called a recapitalization transaction that certain businesses will do. And mainly it's, I've been bootstrapping from all these different various sources. I got a very messy capital table from 6 different providers or whatever it ends up being. And I want to consolidate with one, right, and get get one single person to deal with on the other side. And then depending on their preference for the amount of capital they can provide for your business, there are potentially different things that you can do with it. So if you're a stable business, you're consistently producing cash flow, you're growing at a nice, healthy, steady rate, you might be able to go out and borrow money to literally take it and pay back other people along the way and retire them from your table. You can do that with other debt providers. You can do that with what we call mezzanine providers, which are somewhere between debt and equity. And then you can also do it with your equity table too. You can buy back stock. You can pay a one-time dividend, all these different ways in which you can return capital to somebody. So those are other ways to do it. And being able to unlock that, it really requires some degree of growth through time and scaling the business to some consistent level in which that person's comfortable providing you that capital. It's a very common strategy in the private equity world to buy a company with a bunch of borrowed money, work that money down by optimizing the performance of the business, and then go back and borrow a bunch more and pay everybody a nice, healthy dividend, and we all get to go buy a boat or something, right? But it takes time. So it's one option. It's not the only option for recouping value for people.
Are you essentially like, do you need to go to investors with some idea, especially like in the earlier stages, that like you're going to be acquired and like here's your plan for that or your timeline for that, so that they want to come in and make that initial investment, and then later on when you're able to, show some growth over time, then you can go back and have those other options available to you. But you need to start off with that sort of strategy of being acquired. Is that what you're?
Yeah, I would say so. Mark probably has an opinion on this too that could complement mine. But my view is that you need at this stage of a company, you need to know kind of like, all right, what do investors in my space look for at this stage, and then where is the next stage, and who are the investors that operate out there, right? Because you need to grow your company in mind to be able to create that, because whoever's coming in now, particularly on the equity side, while they have a longer investment horizon, right, in which they need to be paid back, they still have an investment horizon with a finite end, right? And you need to be able to think about, all right, well, if they need to get out in 7 years, what does my company need to look like in 7 years to unlock the next set of investors who are going to recycle their money into this and let the other person take their returns and go. So that's, I'd say it's a primary way. Like the recapitalization through debt strategy is something that if you've got the type of business that's very consistent cash cow you can execute on, it's probably a lower probability outcome in terms of creating value for existing investors through time. So it is more of the knowing who the next round of investors are and at what type of company they like to invest in. That's going to be your primary 75-80% of the time type of strategy, in my opinion.
Mark, any thoughts?
Yeah, I kind of agree with that. I think at this point of your development, I think probably the best thing for you to convey to investors is that you are open to various options, right? So that you are open to the potential sale of the company. You are open to kind of trying to charge through and go public. You want. I think that investors just looking for some comfort that they will be able to exit at some point within their as elements their time horizon, right? And so at this stage of the, it's not, I think, till you kind of really start, you're kind of in the market, you're kind of beginning your growth phase, with those investors, the exit conversation becomes a little bit more pointed, right? At this point, I think you just want to convey that, I'm an entrepreneur, I'm in this to, grow a business and, basically make sure you make your money or your expected return back. And, I want to generate wealth for myself. And I'm open to options that may present themselves in the future to achieve that. That's what I need to know. as opposed to you saying, hey, I'm coming in and I'm going to create a public company and, I'm going to try to grow my business to be in the Fortune 500. Okay, so that's, not a high probability, from the investment point of view, right? That doesn't happen, on a regular basis, right? It's easier said than done, right? So
Sure.
that tells me a little bit about, my ability to work with you and the prospects for the company. So I think to the extent that you can make me comfortable, that you are, willing to deal with whatever the situation is in the future when it comes time for some kind of exit discussion, then that's what I really need at this point.
Excellent. Gentlemen, I really appreciate your time. I'd like to just ask this one last question. We can sort of wrap from here, if that's okay. And it's not the easiest one to answer, but I feel like I really have to ask it. Does race matter in this world? I mean, relative to equity and getting investors? Is there a different strategy for a Black CEO than a white CEO, for a male than a female? Does race matter, and what's the advice on that? I mean, do we have to? And I grew up at a time where they were, you got to be 10 times better in order to be viewed the same. Is that a factor today? Is it still a factor, I should say? And I'd just be curious to hear your thoughts.
Okay, I'll go. Yeah, I think it is. I mean, if you look just at the data, right, it'll show that minorities get fewer amounts of venture capital financing. Women get less amount of venture capital financing. Even on the lending side, right? Accounting. I was at the SBA for a few years, and we had a guy come in and give a presentation discussing lending patterns with minority entrepreneurs. And they said, even accounting for experience, education, the whole 9 yards, minorities still got, less, got approved for loans less often, and often got, worse rates. But you can't let that stop you, because it's hard, I think, to kind of call out, where it occurs. There are a lot of legitimate reasons that a lender might not lend to a small business that you may have.
Right.
It may not be collateral, your credit score
Right.
might be bad. That doesn't necessarily mean it's because you're a minority entrepreneur. It's because, my guidelines as a lender says,
Yeah.
if there's no collateral there, I can't make the loan. So I think you have to be cognizant that it happens in the market. And, I think the best way to combat that is to, have your stuff together, make it tight.
Right.
Be able to answer every question. You have to demonstrate. As John said. Unfortunately, I think it still holds true. You got to be 10 times better to kind of stay in this game, and you have to try to find those pockets of money that are interested in financing women investors, interested in financing minority investors. They're beginning to pop up now. I mean, there's some out there. So,
Right.
Organizations like the National Association of Investment Companies, this is a trade group of all minority fund managers out there. Now, they tend to be for larger companies, but
Right.
there are entities out there, and you have to use your networks to try to find where that supportive money can be. Particularly through this period, until you get to the point where all the other investors can just compare you kind of business to business.
Gotcha.
Like, you're in this industry, and all these other companies in this industry, but this is what you're doing. This is what they're doing. In theory, technology is supposed to be, totally race agnostic, right? If you got the good tech and you got a good business, then that's all that should matter. But the data tells us that it doesn't necessarily play out that way. So you need to be aware of it, but you can't let that stop you.
Thank you. Any closing thoughts as well, Alan?
Yeah, I would agree with Mark in that there's some explainable variables, right, that are correlated with racial or socioeconomic status or gender, right? And then there are obviously things that aren't. And how do you explain away the things that aren't? I would say that yes, it's bias, right? There are inherent biases that people utilize in their behaviors day in and day out, and some of them are very conscious and some of them are very unconscious, unfortunately. And those are the harder ones to correct for in the market. I always like to describe to people that lending is, in fact, a behavioral exercise. It is not something that is formulaic or strictly based on the math or strictly based on certain parameters. And if you clear them, you get over the line. There are certain things that you have to clear, as Mark alluded, that they're insurmountable. But then there are certain aspects that aren't, and it's hard to explain why it happens. And I think the people sitting in the chairs across the table and kind of control for that. I mean, there aren't enough voices on the other side of the table in the lending community or the investing community that understand what it is a minority business owner or an underrepresented class of business owners trying to do. So I think as that starts to correct for itself, certain things should start to balance or at least improve on the margins. But it is something that, it's not going to be fixed tomorrow. It's not going to be fixed probably in my lifetime. But it's getting better every day. I can tell you that. It's not perfect, but I think a lot of people are trying to be as responsible and as knowledgeable as to why they're making the decisions that they are and try to control for those things.
That sounds like another customer discovery call for you, Angel, just in terms of, really getting into this. No, I appreciate your candor, Mark and Alan. I appreciate your time. We appreciate your time today. This was, as I said in the beginning, it was always a tough conversation for me because it was the one that really exposed my flaws and my background and weaknesses. But I did find a way through. I wanted to just sort of talk about that personal journey and give the hope to our CEOs and other Black CEOs and emerging CEOs that, it's possible to do these things. I know it is. And you both have helped us understand how to chart that course a little bit better. So we really appreciate your time and your investment in us today. And thank you.
Great. Thank you.
Great.
All right, folks. We'll connect another time next week, folks. Thanks, everybody. Take care.
Thank you.
Bye.
Bye-bye.